Good afternoon. Thank you for joining us today. My name is Patrick Gill, and I'm the Senior Director of Tax and Financial Policy with the Canadian Chamber of Commerce. Joining me today are two Grant Thornton representatives, Tara Benham, National Tax Leader, and Dennis Tmej, Partner Tax Services, who will discuss recent changes and updates to tax rules affecting businesses that may present both challenges and opportunities with respect to tax planning, compliance and strategy, including estate freezes, estate planning alternatives, and loss consolidation strategies. Thank you for joining us, and please enjoy the presentation. I turn it over to you, Tamara and Dennis.
Thanks, Patrick. So as Patrick said, my name's Tara Benham, and I'm the National Tax Leader for Grant Thornton. And Dennis, of course, I work with closely. He's out of our Toronto office. So what we're going to be talking about today is really some current tax planning strategies. So what can we do today, and what are things that are more suited for the future, and what should we be looking forward to? So I'm going to zone in on the first two, which are really two of the more significant support programs that the government has been offering. And really, what does this circle around? This circles around planning for today. And what does today mean? For most businesses, it's all about cash flow. How do I survive? How do I keep the cash in the bank? How do I keep the cash going throughout the economy? And then Dennis is going to zone in on the next three. So estate freezes, planning alternatives, and loss utilization strategies. And that's really looking towards the future a little bit more once we have survived. So once again, it's how are we surviving the present, and what are we looking towards for the future? So now I'm ready for the next slide, Darlene. Next one. So the first one I'm going to talk about is the Canadian Emergency Wage Subsidy. This is the most significant program that the government has launched. It really is their pillar and their linchpin in how they are supporting our economy, or helping to support it to keep it growing. So what is this one? It's really looking at how do we give back to the businesses so that they can retain their employees or bring their employees back? And why are we doing this? One, we want money within the economy so that we don't, all the various businesses don't fail. But two, we want to make sure that we have that human capital available for when we're ready to start up again, which is coming in the near future, hopefully. So what does this one look like? It's calculated based on the level of decline in revenue in a given period. And I'm going to go into that a little bit because that may seem simple, but it's very complex. This legislation, it's in the Income Tax Act, and it was rolled out really quickly. So COVID kind of started, I guess March 17th is when Grant Thornton shut down. So April 2020 is when the first round of legislation was issued. So really quickly, really fast, and quite complex. They realized in July that it needed some tweaks, and there wasn't a lot of uptake, so they did amend the legislation in July, and they did it again in November. So what happens when you do something that is fairly complex fairly quickly? Well, there's things that are missed. The legislation is a little bit onerous, and it's quite complex. At first blush, it kind of looks a little simple, but when you look at it from deeper, it really does have a lot of nuances, which I will point out some of those. So who is eligible to apply? Individuals, corporations, trusts, charities, and not-for-profits, and partnerships with any of those as members. Also Indigenous organizations and private schools. So who's really not covered by this net? And it's basically public institutions, which is a defined term. Kind of makes sense. The public institutions in general are funded by government, so why would they subsidize and circle it back? So those are the ones that we're really looking at. How do you qualify? Well, we have to have a revenue decline, and I'm going to go into what that means because it's not as simple as that. A key is the second bullet there. We have to file our claims by the due date. This legislation was passed really quickly. Most legislation in the Income Tax Act provides for the ability to late file if you've missed something. This legislation does not. So if you miss the deadline, it's gone. And the first 6 periods, there are 16 periods right now, kind of on 4-month rotation or 4-week rotations. The first 6 periods are actually now closed. The other things you need to qualify is you have to have a payroll account or have used a third-party payroll provider on March 15th, 2020. So essentially what they're saying is, in order to get the wage subsidy, you had to have employees, which actually kind of makes sense. Although there are places or people who have fallen through those cracks. So if we go to the next slide, Darlene, if we look at it, I talked about the revenue decline. What type of revenue decline do we need to qualify? So right at the beginning of the pandemic, so March of 2020, we had to have a 15% decrease in our revenue. April, May, and June, we had to have a 30% decrease. And in those scenarios, 30% was a bright line test. If you were 29%, you did not qualify. If you were 31%, you did qualify. And the wage subsidy was 75% of the baseline remuneration. Because the uptake wasn't as great as they were hoping it was, they changed the rules in July. So that's the second batch of legislation. And essentially what they did is they opened it up, and it was any revenue decline percentage would bring you into the net. And so that really opened it up, and a lot more people did qualify. So if we look at it, we have to have a decrease in qualifying revenues. Well, how do you calculate that? Well, we have our current reference period, meaning the month that we're looking at, and our prior reference period, meaning the one that we're going to compare to. Not quite as simple as that, because there's different versions of qualified reference periods. Sorry, and this is what you get for working from home. I'll shut that off. And I'm going to go into what that means, because there's a couple of different versions. Qualifying revenues, once again, what is revenue? How do we calculate that? There's many different ways. They're complicated definitions, and there's lots of choices and elections that we can have. So I saw in the Q&A that was coming through, one of the individuals posed a question. It said, my business partner is getting significantly more in wage subsidy than I am. Why? Well, it's likely for these reasons that your business partner's accountant is looking at it and using a prior reference period or prior methods or different methods to calculate. But I'm going to go through that to a certain extent. So next slide, Darlene. So how much is the subsidy? And is this worth kind of the bother? The short answer is yes. It's equal to the percentage of our revenue decline times the eligible remuneration. So for periods 1 through 4, this is when we had the 30% threshold. It was a 75% maximum of the eligible remuneration. Eligible remuneration, what does that mean? It's $1,129 per week. So if you're eligible for the maximum, you multiply the 1129 times the 75%, and you can get up to $847 back on that subsidy. So when does the tipping point of when you're going to get that maximum? Basically, anybody making more than $60,000 a year, you're going to get the full subsidy for them. Periods 5 through 16, as we said, they opened it up. It was any decrease in revenue. And the maximum varies depending on what the period is. It goes all the way up to 85%. So if we look at it from what is this really worth? $847 per week. So per employee, that's $3,388 per month. So you put this in context, you have 10 employees, that's $33,880 per month that you could get back as a subsidy. So the quantum of these claims is actually quite substantial. Next slide, Darlene. So as we talked about before, I'm not going to go into this in too much detail, but in essence, we passed the legislation really quickly. There was a whole bunch of kind of scenarios which were unclear or were missed. And so we've gone back and we've picked up a whole bunch of different entities and qualities that can bring us into eligibility. So for instance, if we had amalgamations or windups in the current year, well, we're comparing revenue from one period to another. Well, if it didn't exist in the other period, how does that qualify? So they brought in place rules where you can pull in the amalgamation and the windups. If we bought assets, so we bought assets and now our revenue in 2020 have gone up because we have all these new assets. Well, if you compare it to last year, our revenues didn't go down, they actually went up. So they brought into place rules on that. Indigenous corporations and partnerships, private colleges and private schools, journalism organizations, and athletic amateur associations. Those are all places that were missed at the beginning. And they've picked up so that they are eligible. So I guess the moral is on that one, if you do, or if any of those are ringing bells for you and your business, you might want to go back, talk to your accountant, say, hey, I know the rules changed and they folded in a little bit more on the definitions and the eligibility. Can we revisit whether I qualify or not? So next slide, Darlene. So as we alluded to previously, there's a whole bunch of different ways that we can calculate revenue, and that what kind of periods are we looking at. So we're making elections on all of these different things. So I'm not going to talk to all of these, but I will talk to some of the more common ones. So if we look at it, we have to get a revenue decline. So how do we calculate that? Well, we can calculate that on a non-consolidated basis. So what that means, if I'm a corporation or a business, I just straight up look at what my revenue is, and I say, okay, let's compare that to one of the other reference periods. What about if I have a consolidated group or an affiliated group of companies? We can also make an election and basically say, I'm going to add in all of the revenue together of the full group, and how big is my decline now when I compare it to a reference period? That might make sense, and in fact it does make sense. We had one company, and the non-consolidated, so just the entity level, it had, let's say, a 50% reduction in revenue, whereas we added the group together and it had a 30% reduction in revenue. But when we added them all together, what that did is it made every single group or every single corporation in the group eligible, and one of the ones with the lower percentage was the one with the most employees. So by actually allocating or electing that lower percentage, we got a higher claim just because of that. The other one that is kind of confusing is how do we calculate revenue? So cash or accrual counting. So we can pick which method we want. Most corporations, they work on an accrual method, meaning that if you issue an invoice, that goes into revenue. You haven't received the cash yet, but it's part of your revenue. So you can either do it on your standard accrual method, or you can allocate and say, no, I'm going to work on a cash basis. So even though I've issued that invoice, I haven't received the cash. We had one client on this, and they came to us with their accounting accrual calculations, and we said, let's just try the cash methodology. And it actually increased their claim by about $100,000 for the first 5 periods. So it made a huge difference. As I talked about, asset acquisitions, and we bought a whole bunch of assets, so obviously our revenue has gone up in the 2020 period. We're allowed to look back at the prior year and say, what did the revenue on those assets, what was it? And I can include that into my differential. And the final one, which I find is really kind of hooks clients up, is the prior reference period. So what am I comparing to here? So for instance, July 2020, I look to July 2019, and if my revenue didn't go down, well, I might not qualify. Well, there's another rule which basically says I could also compare my July 2020 to a January, February 2020 average. So I have had, quite a few clients who, they just kind of don't even think outside the year-to-year comparison to this January, February average, and it pulls them in. For cyclical businesses, this is in particular something. If you think about it, if January, February, you historically don't earn a lot of revenue, and then it goes up, your percentage decline is going to be significantly bigger. So I guess what this says to us is there's a bunch of different ways to get to revenue. There's a bunch of different ways to compare. And that's really why kind of bouncing it back to your accountant and saying, have I got this right? Is there any other things that I should be considering to maximize that claim? Because we do have a whole bunch of examples of clients come to us with what they think the idea is. And then we do find a way to use the rules. And that's what the rules are for. It's the government wants to give as much money and put it into the economy as possible so that we can be there at the back end. So next slide, Darlene. I talked about there being 16 periods. How many of those are remaining? We are currently, periods 1 through 6 have closed, so there's no going back on those ones yet. We're kind of hoping that the legislation will change and they'll allow us to late file, but we have had no announcements on that yet. So right now you can see here September 2020 is the current reference period that is open. That's period 7. And essentially, this is kind of how we compare. So for example, here we look at it, November 2020. If we're going to claim for the November 2020 period, what am I comparing to? I calculate my revenue based on one of the different examples that we've given or ways that we've given, and we say, okay, I can compare that to November 2019. What is my percentage revenue decline? Then I can also look and say, what is my January, February 2020 average? Is that percentage bigger or smaller than when I compared it to 2019? I pick the bigger of those two percentages, and then I look at it and I say, okay, what kind of claim can I get for that? So you can see that in November, the maximum percentage was 65%, which we take then our eligible remuneration, the 1,129, and multiply that by 65%, and I can get $734. You can see actually on the December period, we've switched back. The government was decreasing the maximum benefit, and you can see that they've increased it back to 75%. And I think that's really, they were looking for the economy to start rolling and turning around, and then they saw that it wasn't turning fast enough, so they increased the percentage again. The next slide shows you what was recently announced, and these are the final 3 periods. So June 5th is when the final CEWS claim can be made for that period, so May of 2021. And you look at it and you say, okay, well, I know that I compare my current period to my prior period, but if I'm going to compare May 2021 to May 2020, that's really not going to get me much of a decline because they're both in COVID years. So they acknowledge this, and that's where you can look at it and say, May 2021, we're going to compare to 2019. This is an indication that they think the economy is going to turn in June of 2021, hoping that it does. And if it doesn't, what it will require is more legislation to bring this back in. Next slide, Darlene. So this slide, I'm not going to go into it in a lot of detail, but essentially, kind of on the right-hand side, the revenue reduction percentage, that's what we were calculating, our current period versus our comparative period. What you should take away from this slide is that we figure out what our revenue reduction percentage is. So in the current month, it's say 30%. But let's say in the prior month, it was 35% or 40% or 60%. We're allowed to pick whichever one of those periods we want. So a lot of clients, they kind of look and say, I qualified for the last period, but I don't qualify for this one. Well, you can actually get that additional period is really the moral of the story. Next slide, Darlene. Thanks. From an administrative perspective, the deadline to file a claim, when is that? So the first 5 periods, the deadline was January 31st. Period 6 was February 25th, and it's a rolling 180 days after that. So you can see here the qualifying periods are ending. They're of course not on month ends. September 6th, October 24th, November 21st. Our next deadline is coming up March 25th, 2021. And like I said, if you miss that deadline, it's the point of no return. You cannot come back. So if any of the things that I've previously talked about have kind of cued you that maybe you should go back and revisit, now is the time, because your accountant doesn't have that many days left to look for a claim. So currently, as I said, this has been extended up to June 5th, 2021. And the other interesting part about this is I've said there's a hard deadline. If we happen to file, so if you don't file, you get nothing. If you do file, can you amend the claim? The answer to that question is you can amend the claim down, you cannot amend the claim up. So for instance, if you put in a claim for $10,000 and your accountant, or you discover that, well, it could have been $15,000 or $20,000, you cannot amend up. Once again, we're hoping that that legislation will be amended such that we are allowed to do that. It is really complicated, mistakes happen, and I'm hoping that the government looks to the purpose of the legislation versus the letter of the law that they've got right now and really amend that. Next slide, Darlene. Thank you. So if you do receive the subsidy, what does that mean? Essentially, the subsidy is considered government assistance, so it is included in your income. You do pay tax on it. Does this make sense? I think it does, actually. If you think about it, you're getting a subsidy for paying salary and wages. You get a deduction for the salary and wages that you pay. So the fact that on a net basis, you're not paying the subsidy amount, it kind of makes sense to include that in income. When do you have to include that in income? Let's say you haven't applied for December yet of 2020, but you do qualify and you intend to apply for it. It's deemed to be received and included in income when you qualify, not when you apply for it. So that's a little bit of a confusing bit there. The accounting treatment and the tax treatment might be different. So why would you want it to be different? You have to talk to your accountant about this, but it might be covenants and stuff to do with the bank where they could look at it there. And the other thing to note is if you do SHRED claims, so scientific research and experimental development or things like that, the CEWS claim or subsidy does reduce remuneration for those purposes. So one of the things here you might say, okay, I've got the government assistance. From an anecdotal perspective, how fast do I get this money? Because once again, cash is king, and that's really what we're looking for here to survive. What we're seeing is an amazingly fast turnaround. Most claims, you submit the claim and the cash actually lands in your bank within 5 days. So what kind of size of claims here? I talked about it before. If you've got 10 employees and you qualify for the maximum, which many clients do, that's $33,000 per month that's coming in. So it is a significant amount. To date, I think it's $68 billion that has been paid out. There's actually, if you're interested on CRA's website, there is a ticker there of what size of claims, how many applicants. So I think it's 2.8 million applicants, and like I said, the $68 billion in claims. So next slide, Darlene. Thank you. So now I'm going to talk about the next government program. This one is called the Canada Emergency Rent Subsidy. The name is very misleading because it's not just rent, it's if you own as well. So what is this one? Essentially, it helps businesses cover rent, mortgage interest, property taxes, and insurance. This one is retroactive, so September 27th, 2020, and I can't remember if it was last week or the week before, it was extended to June 2021. So there are 9 periods in this one. And what does this subsidy look like? There's 2 components to it. So the first is the basic rent subsidy, and that's, you can basically get up to 65% of your rent covered. And then there's an additional layer for the more hard-pressed businesses, and what this is called is lockdown support, and it's up to an additional 25% subsidy. So you could get 90% of your rent or kind of running costs on your property covered. So who can get this covered? Essentially, it's available directly to tenants or property owners. You might remember one of the previous programs, the SECRA, and that one had the landlords having to apply for the rent subsidy, and they also had to forgive an additional 25% of the rent. So this one is much more direct. The tenants have felt the loss. The tenants can apply for the subsidy. If you have revenue loss of 70% or more, you get the full 65% subsidy. How is revenue loss calculated? Exactly the same rules and all of the complexities that I talked about in the wage subsidy. Those calculations apply here as well. So 70% decline, you get the 65% subsidy. Less than 70% decline, basically the subsidy gradually decreases, but you do get a percentage of it. And then the lockdown support, how do you get that? Essentially, you have to experience a shutdown, which is due to a public health restriction. And I will go into that in a little bit more detail coming up. Next slide, Darlene. Thanks. So how does the eligible entity qualify? Meaning what criteria do they have to meet? So they have to be a tenant or they have to be a property owner. So that's pretty much anyone. You have to have a business number on September 27th, 2020, or you have to have a payroll number or use a payroll service provider. And then one that we find is actually creating more challenge than you'd think is you have to have a written agreement or renewal with an arm's length party prior to October 9th, 2020. So some of these scenarios that I'm seeing or we're seeing are costs that the tenant is paying and has been paying historically for years, but it's not embodied in a written agreement. Technically, those don't qualify. So what do we do about that? That's a really good question. What kind of expenses are eligible if you rent? You can see them there. There's gross rents, net lease. If you pay rent based on a percentage of your sales or your profits, or if you regularly pay amounts for services to the property, essentially all of those qualify. But once again, they have to be in that written agreement. What about for properties that are owned? Essentially, this is the interest on our mortgage, our insurance, and our property or similar taxes. How big is this subsidy? Next slide, Darlene. This one is also fairly large as well. So we essentially figure out what our qualifying rent expense is based on the definitions high level that I gave you in the last slide. We multiply it by the percentage, rent subsidy percentage, and then we say, okay, what did that fall out to be? On maximum, we can get $75,000 per qualifying property per period. There are 9 periods. If you have a group of companies, so an affiliated group, the maximum is $300,000 per period. So once again, if you're this really is a kind of what we would consider significant support, and it's not on this page of my notes, but it's coming up on my notes. I think it's $1.8 billion has already been paid out on this one. And from our clients' perspective, this one we're finding that a lot of filings haven't been made yet. The first deadline hasn't come. It's coming April 22nd, 2021. And so the fact that 1.8 billion has already been paid out is pretty significant. Most of our clients have been kind of running around doing the rent subs or the wage subsidy right now. So this one I expect to grow significantly in the future. Next slide, Darlene. Thank you. So lockdown support, how do we get that extra 25%? Essentially, like I said, we have to have a public health restriction. What does that mean? It has to be due to COVID 2019 pandemic. The business has to be within geographical boundaries. The type of business or the activity the business is in has to have been restricted in that restriction, the public health restriction. There has to be federal or provincial penalties that apply if you contravene the rules. Some or all of the activities of the business have to be required to cease. So this is, for instance, we all know that Ontario has been in lockdown. I'm on the West Coast, so fortunately we really haven't been locked down a heck of a lot. But in Ontario, basically all the businesses don't qualify, only the ones that are directly affected by the lockdown. And essentially the restricted activities of that business, a minimum of 25% of their qualifying revenues have to relate to the activity that has been restricted. And also the shutdown has to have occurred for at least 1 week. But for, I guess, Ontario and Quebec, that would actually, I do think that a lot of businesses are going to be affected and benefit from that. So we look at it, one of the most common questions that we get from our clients is, I have my operating company, I have my holding company, I don't have my real estate in my operating company, it sits in my holding company and I pay rent. Can I claim? Because we know that owners can claim, but what does that look like? And the answer is yes, you can claim. So in a scenario like this, there's 2 elections on how do we how do we calculate our revenue decline? And so the first way that we can do it is they call it the affiliated group or the consolidated method. So essentially we add up our holdco revenue and our opco revenue and any other companies within the group. What is the affiliated group's revenue? Compare that to the periods, just like we did with the CEWS, and what is our decline, and then apply that to the rules. The other way that we can do it, there's another election that we can look at. So it's the 4D election. And essentially this is the one where holdco can say, hey, I'm entitled to this, this subsidy, but I'm going to look to opco's revenue decline and use it only and apply that to the rules. So those are the two ways that we can do it. So if we do get the support, what does that look like? Once again, it is government assistance, so we are going to pay tax on it, and we're going to have to include it in income. When do we include it in income? At the end of the qualifying period. So basically, when we are eligible for it, that's when we're qualifying for it. And our accounting treatment, like I said in the previous version, was or may be different than our tax treatment. Oh, and here on my notes is where we've got it. So to date, we have 470,000 claims. $1.81 billion has been paid out. And like I said, I think this one is going to explode up because the due date is for the first filing period hasn't come yet. And of course, human nature, we always wait till the end. So next slide, Darlene. So what are we seeing from a 2021 outlook perspective? Well, we're seeing a lot of uncertainty. We're seeing that the government is looking to support, specifically with these two larger programs. We know that till June 5th, 2021 is when they've kind of rolled out the latest. So lots of uncertainty. This is going to lead to, of course, a decrease in the value of a lot of our companies and our businesses. And Dennis is going to talk about some of the opportunities and the planning when we're in a place where the decrease in value has occurred. The other thing that we need to look at here is currently, or prior to COVID starting, we were projecting $119 billion deficits. Now, with all of these programs being rolled out, we are projecting a $382 billion deficit. So what does that mean on our outlook for the future? Well, we're going to have to pay for that somehow. And we're looking to say, what does that mean from a tax perspective? It's not going to go down, so we think it's probably going to go up. And once again, this is where Dennis is going to look at, in an environment where values have gone down, we think taxes are going to change. What does that look like, and what kind of planning opportunities can we kind of discuss with our clients? So before I end, I'm going to kind of go with a positive note, and it's really a positive story that I want to talk about. So the warm and fuzzy. And so this is a client that wasn't expecting anything from our program. And essentially, so it's a potato farm in the PEI. They have 13 employees. And in 2020, they were, at the beginning of the year, they were doing quite well. 2019, they had an amazing crop of potatoes. So, you pull the potatoes out of the ground in September, October, and then you sell them in 2020. So that's why they were having a great year. 2020, they had a drought. So end of 2020, don't have a lot of potatoes to sell. The client said, well, in 2020, I sold all my 2019 potatoes. I did great. I really didn't have a revenue decline, so I don't think I qualify. We sat down with them and we had a conversation. We looked at the various methods of how can we calculate our revenues. There's the cash method, there's the accrual method. In this scenario, there was a US dollar component that we looked at. And basically, instead of not qualifying at all, this client qualified for March through December 2020, and the claim was $210,000, which is significant given that they thought that they were entitled to nothing, and it really helped fill the hole of the drought in 2020 that they realized. So what is the moral that you need to take away from this is, even if you don't think you qualify, it's worth having a conversation with your accountant to say, hey, can we just revisit the rules and talk through it just to make sure? Because sometimes it's just plain old not intuitive. And then finally, we've talked about 2 of the programs that are available. Next slide, Darlene. Thanks. So 2 of the programs that are available, we picked those 2 because they are the biggest. They're the ones that the government is throwing much of the financing to try and keep the economy going. But on our website, we do have a whole bunch more, essentially white papers on different programs as they roll out. So we've given you a list here and on the next slide, which you can click on those. I do understand that you're going to, if you haven't already got the PowerPoint slide deck, you will be getting it, so you can navigate to these and look at them. So that is it for me. I'm going to pass it over to Dennis, and he's going to really focus more on the future, because what I've been focusing in on is how do we survive the present. So that's it. Thanks.
Thank you, Tara. Hello, folks. I hope you're all doing well. And it's interesting. Just a brief side note. I think a lot of what I do in the world of tax planning and strategy is focused on shareholders and corporations and their structures and their shareholdings and how to deal with transfers of wealth. And there's many times when people say to me, my goodness, some of this stuff is fairly complicated. But I got to tell you, I step back and I look at the CEWS program and the rent program and what's involved in the claim process and the computations. And sometimes I think I've got it easy. So on that note, I'm going to move forward and talk about estate freeze strategies, etc. So looking at reevaluating your estate plan. And to me, this is basically not so much just undergoing an estate freeze now, but you may have had one in the past. And you can see I've made reference in our notes about the economic downturn causing a devaluation of businesses, stock markets, and real estate. And now if you look at what's happened as we are basically a year out from when the first lockdown and the whole pandemic, the sense of the pandemic made its way to North America, if you looked at it now, you'd say, I'm nuts. Because the public stock markets and the residential real estate sectors have really, they've been on a big upswing. And you'd think that there was an economic uplift overall. But I would argue that, and not to be a pessimist, the private sector, there's a bit of a disjointedness between the private sector and business and what's going on in public markets, and there are dichotomies even in the real estate market. And there's still much sense to looking at this whole premise of locking in values and reducing taxes. So I'll move on to the next slide. And really what we're getting at is saying, okay, well, why do we care about this? I mean, the central theme is that you want to look at a reduced tax bill and have, enhanced or increased cash flow. So why would I look at it and when? A lot of the trigger points we look at are, is there an operating business that's had a decline in value, or is it pending based on where its market is at and what may come out of this pandemic, post-pandemic? Do you have a family portfolio post-business sale that's been there for a number of years, and has it possibly decreased in value? Even more so, I look at situations involving operators and entrepreneurs, and they're going through significant life changes. There may be marriage, divorce issues, children, grandchildren. You may have business succession planning matters. It may involve key people in the business, key employees. It may involve key family members or some combination thereof. You may get into situations involving your own beneficiaries. If you have an existing estate freeze, and the circumstances governing the beneficiaries may cause you to rethink and basically do a refreeze, irrespective of the value aspect. Beneficiaries have changing life moments. They may be going non-resident. They may, by virtue of going to school or a new partner or whatever a life decision may be, or new job, they may be leaving. They may be outside of Canada and not coming back, or what have you. And so a number of these factors come into play. And when we look at it, we basically have a number of things we try to do. We try to reduce taxes at death. We obviously like to, where it involves a family business, ensure that apart from that, that we can actually help the new generation of tax effectively fund their stake in the business going forward. And there's some other items I've listed there as well. I'm going to move forward to the next slide. So when we look at reevaluating and assessing your estate plan, one of the things we talk about is, so here in this case, I'm going to give a very simple example. Let's assume that Peter had done an estate freeze a number of years back, whenever that was, and the value of the operating entity was $10 million. And at that time, the freeze was done, and a family trust was put into place that included children of Peter, and that trust would have been issued nominal participating growth common shares. And now you look at it and say, well, gee, as a result of COVID-19, for example, I'm looking at this operating entity and I've got a value of $5 million. And so you would look at it and say, well, I might want to consider redoing this because I originally planned on Peter having a death benefit of $10 million in terms of a deemed capital gain. So moving forward to the next slide. When we look at it, I say, okay, if we do a refreeze, that means we're basically Peter is exchanging the preferred shares he has in return for a new class or the same class of shares, but predicated on a new value, and that's $5 million in value. And now basically what we've done is we've basically cut Peter's tax bill in half on a deemed disposition at death. Interestingly enough, when we look at that, a number of things pop into my mind that aren't necessarily on this slide. One other thing we find with this type of a plan in terms of a refreeze is the fact that this may give us a chance to bring family members. I've got reference to a trust here, but to bring family members in terms of income sprinkling and dealing with it in a fashion that doesn't run offside with the tax on sprinkling income or TOSI rules that were announced back in 2017 that have created a myriad of restrictions in terms of income sprinkling and splitting for family members. So this in its sense provides an opportunity in that now one of the criteria is, without getting too technical on you, is that if you have other family members, adult children over the age of 24, and they hold what are referred to as excluded shares, if they have a 10% interest by votes and value, that would allow them to basically fall outside of the tax of the split income restrictions and allow them to have future participation on the profits of OPCO. And so in an example like this, where we've done an estate refreeze, that 10% investment requirement would now be pegged at $500,000 versus $1 million. And then if you say, well, how am I going to get that money? Well, Peter, in this scenario, I'll refer to Peter. There's a couple of scenarios that somebody could look at in terms of either a gifting arrangement with their children or some sort of loan arrangement using prescribed rates to stay on side with the CRA. That's just to give you a sense. And the only other qualitative comment I want to make in this regard is we strongly recommend that when doing such a plan, that a formal valuation is undertaken because you are dealing with a reduction in value. And if there's one area that the CRA does like to look at when you do freezes or any sort of share reorganizations with private entities, they like to see how that value is supported, because the thing they're looking for is to determine if in some fashion or way you've conferred a benefit on other shareholders. So moving on to the next slide. Here we are. Now, this is where I think it gets interesting. And basically, I wanted to sort of give you a teaser with respect to estate planning. And basically, where it really gets fun is where we take estate planning and we marry it with what I refer to as distribution alternatives. I've given you some trigger points here, things that we look for with clients or other prospects that are interested in thinking about this, apart from just looking for tax savings. We look at situations where there may be new shareholders coming in. I may be looking at an opportunity to sell the company or the business down the road very soon or imminently. There may be issues where the owners need to have moments where they're needing to withdraw large amounts of cash from the business for other investment endeavors, etc. They may have just a large purchase on the horizon. And The other thing is I may have, and this may seem sort of contrary to what's going on in the world right now, but there may be excessive cash or liquid assets in the corporations. And in the event the business is being sold, that cash wouldn't go along with it. And there may be other creditor issues. So when we look at this, we say, okay, what do we want to do? From a strategic perspective, we're looking at the succession plan. We're looking at how to distribute cash that isn't going to go somewhere else in a share sale or a business sale. And we also look at, from a tax perspective, can we achieve, where possible, a capital gains exemption, or can we at least purify the business so that down the road for such an event, it will qualify? But even more so right now, we look at how can we distribute retained earnings that have been built up on a tax efficient manner. And one of the things I would address is that when we look at this, we really, apart from the tax savings and the strategic aspect of it, we ask people, where are you going with your business? Is this something that you are going to carry on? Is the family going to carry on? Are there key employees? Or are you going to be looking at a sale? Or possibly you may have a very successful business, but there isn't something there to buy. It's basically personal goodwill. And in that case, you may be looking at an orderly wind down and basically taking the residual as your retirement fund. I'm going to move on to the next slide. So as an example here, we have Peter. He's contemplating retirement. He has a daughter, an adult daughter, Pam, who's going to take over. And Peter, for example, needs $1 million to purchase a property in New Zealand. So moving on to the next slide. In the absence of doing anything, where Peter were to have shares redeemed from his business in the province of Ontario, he's going to have an effective tax rate that could be as high as 47%. If instead he were to reorganize the share capital such that he then sells his shares, a portion of his shares to Pam, he would be instead triggering a capital gain and paying tax at roughly 27% or less in Ontario or what have you. Basically, we use this type of scenario to accommodate people that may need to have a capital expenditure, but we also, interestingly enough, will use it sometimes as a pre-sale event. Moving to the next slide. This is another scenario where we sort of look at it and say, okay, I may not have a child that I want to put money to, or there may be other circumstances involved. And we may look at it and say, okay, we can utilize a intercorporate entity and use intercorporate dividends. And in the fashion of doing that, we would ultimately, and I'll go to the next slide, as opposed to having a straight out share redemption, we would be able to put ourselves in a position where, through a series of transactions, including using a new entity where in effect we would be triggering a capital gain on the existing shares of the operating business and utilizing the new entity as a entity within the family corporate group to basically trigger a share sale. And why do we do this? Because ultimately what we're doing is we're creating a scenario wherein Peter can access either a direct capital gain, or he can access what is referred to as a capital dividend account, which is the untaxed portion of the capital gain. And again, the key here is that we're trying to achieve a lower tax result on taking proceeds out. But again, it's more than just the tax aspect. There are other objectives involved so that we're not looking like we're just playing with tax numbers. It's very important that from a tax perspective, there's more to it than tax, but that there are other strategic aspects involved. I haven't got it on the slide, but we can accomplish things like this where we don't need to use entities, and we can use it with share exchanges and the opcos. And again, the key is what do we need to do with the proceeds? Who needs them? And do they need to be on a personal shareholder level, or can they stay repatriated in a corporate group? I'm going to move on. Just to recap, basically, when we look at a structure in the beginning, we can say, okay, depending on where we're at, if there's a succession plan, if there's a need for capital to be repatriated in the form of cash to fund other things, or if there's a pending sale and we want to lock in the tax results. There's been much chatter and concern over the last number of months that the inclusion rate on capital gains is going to be increased. People have stated that because presently right now it's 50%, and people have stated that they could envision that the increase could go back to what was historically at one time 75% a number of decades ago, or even 100%, so that a capital gain would be taxed the same as regular income. And so in the context of that, we may look at transactions where we say we know we have a sale imminently happening, or we know we want to plan for our ultimate deemed disposition on death, and we'd like to lock in and get certainty on the tax dollars today. And if they so happen to be at a lower percentage and total dollar effect, then that's so be it. And so we can look at it from a personal and corporate perspective in that context. So moving on. And again, so what was I getting at? Basically, I'm not going to run through all the numbers, but effectively what we're talking about, when you look at the third column or the fourth column, we're looking at scenarios where hopefully we're trying to achieve a capital gain tax result as opposed to either a eligible or ineligible dividend, which can range in with an effective tax rate from a low of 40% to a high of almost 48%, and that's for the province of Ontario, but it's not going to vary significantly across the country. And that's irrespective of the fact that regular income is taxed at almost 54% in the province of Ontario. So that's really what we're driving at in terms of taking strategic events today that having those strategic events structured so that a capital gain result is possible. Now I'm going to shift gears and move into something that really, I'm sure, is going to warm the cockles of people's hearts, and that's loss utilization strategies. I recognize that I believe that this is something that will have more impetus, and I'm starting to see some aspects of it as we move forward, and at some point when the government funding and support programs wind down, at some point people are going to realize that they need to shore up what they've done, and they've had expenditures and they may have losses that they need to address and hopefully get the benefit of. And the reason this becomes such a planning exercise and can either be feast or famine and cause joy or grief is one simple fact. In Canada, on a federal and provincial taxation basis, businesses that are formed in a corporate structure file standalone tax returns. Unlike the US or other Western-based type of tax regimes, which allow for consolidated or grouped tax filings, in Canada, they're all standalone corporations. And so you can get into mismatches of having profitable entities that are paying tax, having entities that are in a sector or business that's having a hard time or has, clearly had the ravages of COVID and has losses, and yet those losses can't be utilized to offset profits. And so I've said here, I've listed out some comments, but the end result is you end up with a mismatch, and you have situations where you'd like to see if you can recoup expenditures on lost activities. So moving forward, there's a number of ways historically that we've done these things. People have used amalgamations and wind-ups, and one of the key aspects with that is you basically say, okay, I want to bring together or merge, legally bring together a loss entity and a profit entity. There's a number of limitations that apply. One of the things is that when you look at it, if you do a vertical amalgamation, which is what you see here, where basically a loss is being amalgamated into a parent, one of the benefits of it is that to the extent you have losses in the loss scope, you can go back and there's a limit in the terms of number of years, but you can go back and use those losses against profits of the profitable parent entity in prior years. One of the things that comes up with amalgamations and windups, you may look at it and say, from a legal and creditor perspective, I don't want to bring these entities together. You may say, there's issues in the loss code that I don't want to bring together because legally, in the case of an amalgamation, whatever is in loss code will become part of what the new amalgamated profit loss code is. So moving on. One of the simple things we look at, depending on the structure of the business, we sometimes look at, are there intercompany management fees that can be put in place to recognize that there's activity of an economic benefit that the profit company, whether it's a parent or a sister or a sibling type entity, that it provides to the loss company, and as such, there should be fees that go in place to basically utilize the losses. One of the other things I'll mention is that historically, the Canada Revenue Agency has administratively said, from a transfer pricing perspective, that they'll accept a management fee type structure where the profit markup on the fee is at a maximum 15% of the cost incurred. Anything beyond that, they will draw that into question and may reassess it. Two other things I tell people, when you're looking at an intercorporate type of management fee structure, you may want to bear in mind that there's HST ramifications. You should make sure that the party paying the fee, in this case, the profit entity who's paying a fee to the LOSCO, you want to ensure that the profit entity is a registrant for HST and it also has taxable commercial activity. Otherwise, you're going to have a problem where investment tax credits won't be able to be claimed by the payor entity, the profit code. And one other comment I'll make quickly is I've found in the past, through past experience, some of the other things we do in terms of intercorporate types of fee arrangements, it's not necessarily predicated on a management fee, which is based on the efforts and labor and salaries and of participant individuals. But we'll look at other scenarios like asset-based type fee, which is sort of akin to like an investment fee, depending on the type of sector, industry, and business. And that may create more flexibility in terms of the type of, the level of profits that can be utilized against existing losses. Moving on from that, you may have situations where you have a loss company with significant losses. You may have a profitable entity that has assets with an accrued gain. You may be looking at selling those assets. In the meantime, you could transfer such an asset to the profitable entity. That would create, and you would do it on a tax-deferred basis so that the loss entity could at some point trigger the gain on a sale. This may be useful for one-off type scenarios where you don't necessarily want to amalgamate. Looking further beyond that, you may want to enter into situations where you're transferring assets and using a leaseback or rental arrangement such that you may have an asset in the loss code that or an asset in the profit entity. If you were to lease it to the LOSCO, you could basically create a rental revenue stream in the LOSCO. Again, these are very specific scenarios, but they're very useful. And I would say that one of the other things that comes out of this from a tax perspective is looking forward on a planning, from a planning perspective, you may put yourself in a position where you are not subject to recapture on depreciable assets because you are ultimately, you have a leased asset that's not being sold. I'd like to move to the next slide. This is another scenario we look at in the context beyond amalgamations, where we say we use an equity debt type of structure to basically create intercorporate dividends that are not taxable and create interest income that allows the LOSCO to utilize its losses. One of the things about this is that, again, without using an amalgamation, we sometimes see the benefit that this may be a short-term strategy that's useful, and we avoid basically the structural and legal aspects involved with an amalgamation or a windup. Lastly, in terms of looking at some other loss utilization structures, we've used partnerships over the years to basically take losses in a loss co, and basically, I'll move to the next slide, where we basically create a partnership where you have a profitable entity that has a profitable business. We don't want to put it directly in the loss code. There may be issues that we don't want to, have a profitable business in that loss code. And what we'll do instead is we will ultimately, through a series of deferred rollovers, set up a partnership with a new company, a GP. The profitable entity will have a significant interest because it's going to transfer the business into the partnership. And then ultimately, it will basically pass on that partnership interest through another tax-deferred rollover to the loss co, so that effectively, I've not done anything with the lost business. It has the losses, but now it is a limited partner in a partnership that is profitable, and it is generating profits which are allocated because the partnership is a flow-through vehicle, and the losses are allocated to the loss company. And as such, we're using up the losses that way. And ultimately, when all is said and done, we can say, when it's said and done, we may take the business, bring the two companies together if there aren't other commercial or legal issues in the loss co, and basically by operation of law, the partnership would wind up, and we'd be back to square one with a profitable entity carrying on. The only other comment I'd like to make on the next slide is and a lot of the tax planning we do can have an impact on financial reporting. So I always caution people that you should speak to if you have an assurance advisor, if you have issues with financial statements, if you need to do reporting beyond basic reporting, if you have audits or review engagements. A lot of the things we do from a tax planning perspective involves preferred shares, fixed value shares. These shares can have retraction features. Those features can have an impact on the disclosure on the statements and result in debt classification disclosures versus equity. You get into issues with paid up capital versus stayed up capital. I won't get into the entire laundry list, but there are things you should address so that you don't offend somebody that you need to report to. That wraps up what I'm doing. I think I will pass things back to Tara to let her wrap up about us and what we're about. I thank you all.
We do have a hub where we essentially put a whole bunch of downloadable resources. We did give a list at the beginning for some of those. Navigate to here, so it's grantthornton.ca. I was reading in the chat that some of the links might not be working, but if you route to the grantthornton.ca and just click on the COVID-19 hub, you can get to a lot of these different things. And we do try to keep it up to date with what's timely and topical. So feel free to go there. And I guess from that perspective, I think that is it from our side. I know that we've run a little bit over time. So Patrick, I will pass it back to you, and you can navigate through Q&A for whatever time you might like.
Thank you, Tara and Dennis, for the highly informative presentation. We are over time, and we do appreciate everyone who is still with us. We will try to get to some of the questions, but not all of them today. We will pass all of your questions along to Grant Thornton for their consideration. And of course, if you want further follow-up, I'm sure Tara and Dennis would be happy to connect with you following this. So turning over to Slido quickly, let's just take 10 minutes to run through the questions that we have here. We won't be getting to all of them, but we'll tackle a few that we have. Please do vote on the questions if there's one of greater interest to you. The first question, Tara and Dennis, if you use CRA's calculator and then just go with the results, if there's any error in the formula, who's liable?
I guess I will take that one. And essentially, if it's an error in the formula, CRA will correct it at different, their formulas are actually quite good now. When they first launched them, they were rolling version after version out, and they would find things that were wrong with them. They did correct them. So that I would say if it's math that's wrong, they will correct it, but they'll likely charge the taxes. There wouldn't be any interest or penalties or anything like that if they're clawing back some of the funds. I haven't heard of any errors in the formula in a very long time. So where the errors would come in is in the data input. What are the methods that you have used? What kind of revenues have you entered? What kind of percentage decline have you calculated? What's your different reference periods? And so that would be where the errors would come in. And I would say from that perspective, if your data is wrong, CRA is going to come back and correct it. And that would be on the business.
Thank you very much. Now, I believe this was touched on during the presentation, but just for further clarity, are government founding grants and other subsidies considered as revenue?
Short answer, yes. Yeah, it's essentially, if you look at it from that perspective, we paid $100,000 in salary. We got $75,000 of that back as a rent subs or as a wage subsidy. So from that perspective, it makes sense. I'm going to deduct the $100,000. I should bring the $75,000 into income. So I'm going to net out at a $25,000 expense. And from a logic perspective, that gets you to the right result.
Thank you. A question from a participant asking, can we change the baseline revenue from month to month comparison to regenerate period from January to February 2020 for previously claimed periods and adjust our claim for the current open periods?
Short answer, no. When you do, you have to basically choose a method, and once you choose that method, you have to stick with it for all of the different periods, which is one of the reasons why many companies have kind of waited until further on in the claim process so that they can really, look at it and say July, August, December, does the affiliated election or does the January, February, does that make sense? And actually, sorry, the affiliated versus the consolidated versus non-consolidated, that you can switch back and forth, but how you calculate your revenues and what is your reference period, those you cannot change.
Great, thank you. And we'll skip over the next question because you've just answered that specific thing on comparison of revenue. Can you change your elections from claim to claim?
Each one is different, but in general, the answer is no. Most of them you're stuck with. So like I said, the affiliated versus non-affiliate, that is an example of one that you can change, but most of them you cannot change. And the other thing to note there is when you make the election, so say for your CEWS, so your wage subsidy claim, all of those elections also hold for your CERS claims and how you calculate revenues in that respect.
And for CERS, what is the difference between affiliated versus non-arm's length?
Now this one, just because I want to share, Dennis, do you want to take this one? Because it's just the straight up definitions in the Income Tax Act.
I would say that as defined in the Act, non-arm's length can basically mean that you're related as opposed to being at arm's length. And related is basically means that you can be related either personally by way of blood, marriage, or some variation thereof. And when it transcribes in terms of corporately, corporations are related based on common control and in different shapes and form. And you can have individuals that are related with corporations, again, based on having control over that entity. So that is related, and related is a form of the definition of non-arm's length, and non-arm's length actually extends beyond related persons to have I guess I'll call it a capture-all type of clause, in that if you have two parties that otherwise would be considered to be at arm's length, but if they're, I guess this is not the exact verbiage, but if they're acting in concert, then they can be deemed to be related. So that's what related means. That's what non-arm's length is about. Affiliated is a much more restricted definition, and it basically refers to entities and people that are affiliated by specific types of common control, but for example, it would exclude, for example, spouses would be affiliated, but your children would not be affiliated with you, as opposed to normally your children would be related with you, as an example. And the same sort of quirks extend to corporations. So affiliated is a narrower subset of, non-arm's length.
So as you can tell from that definition, it's confusing.
It's very confusing. Yeah, I'm laughing at myself. I can't see all the participants, and they're thinking, so what did you just tell me again?
Referred to the act.
Yeah, exactly.
That's just it. Like, that's why I even tell even people I've been mentoring for years, I say, you know what? There are really very few instances, except for the very simple scenarios where two are exactly alike, and you basically have to stop and look at it and say, okay, where does everybody fit in on this picture or puzzle? And then make your assessment, and then how that applies to CEWS, CERS, or anything for that matter.
Yeah.
Okay, let's try for 3 more. What is the correlation between the small business deduction and CEWS eligibility, if any?
There is no correlation. An eligible entity, it just has to be a taxable corporation. It doesn't have to get the small business deduction or be entitled to it.
Great. Another participant asked, we did not select the election for not-for-profits to omit government funding from revenues when filing claims online, but periods are now closed. We do have paper copies, print and signed. Do we amend our applications online for closed periods? If yes, how?
So if you did it wrong and you think that you need to correct it, then yes, you should. My understanding at this point in time is there is no way to do that online. You simply have to pick up the phone and get an agent, and they will walk you through how to amend your claim.
Great. And the last one, has home office expenses claimed on the T1 for 2020, has that changed significantly for those who regularly file for the home office expenses?
My understanding is that the basic normal premise for filing and claiming home office expenses outside of this specific allowance that's been made for $400, which as I understand, is predicated on so many dollars per day, and then you look at whether you qualify. But the basic home office expense deduction outside of this specific aspect is there is no difference. It's the same criteria that you have to adhere to in terms of eligible expenses, and the same criteria in terms of having an eligible home office. So I'm going to go on a limb here. I would suggest that the biggest factor here in this scenario, in this COVID world, and people working at home on a pandemic basis, is that if you want to make a claim that would benefit you, that extends beyond the $400 basic formulaic available deduction, the key thing to remember is that you then specifically have to make sure that you qualify in terms of the expenditures. There are some differences between employees that have commission or sales type income versus not. And last but not least, you better make sure you have the documentation. You'll need to support that claim, that expense claim, with invoices, documents, or proof of payment, not on the filing, but obviously if there's a subsequent review. So that's the key carry.
Well, and not only that, the one additional thing I would add is if you're not going to use that simplified $2 a day method, you do need a signed T2200 from your employer. So there's a simplified form on that, but it is also needs to be kept with all of the receipts and documentation that Dennis talked about.
Yeah,
great.
The old T2200.
Well, Tara, Dennis, thank you so much again for your informative presentation, and we're so appreciative to our sponsor, Grant Thornton, for today's very important webinar. Thank you, everyone who joined us for this important conversation. If you have any additional questions regarding this presentation, we encourage you to contact Tara and Dennis directly. Again, thank you very much, and enjoy the rest of your day.